Hello, and welcome to my channel, where I share tips and tricks on how to improve your financial situation. In this video, I'll show you the ultimate guide to repairing your credit, whether you have bad credit, no credit, or just want to boost your score. Your credit score is a number that reflects your creditworthiness, or how likely you are to pay back your debts. It ranges from 300 to 850, with higher scores being better. Your credit score affects your ability to get loans, credit cards, mortgages, insurance, and even jobs. It also affects the interest rates and fees you pay for borrowing money. Having a good credit score can save you thousands of dollars over your lifetime and help you achieve your financial goals. But having a bad credit score can make it hard or impossible to get approved for credit products and services, and cost you more money in interest and fees. But don't worry, if you have a low credit score or no credit history at all, there are ways to repair your credit and improve your situation. It may take some time and effort, but it's worth it in the long run. In this video, I'll cover these topics: how to check your credit score and credit reports, how to dispute any errors or inaccuracies on your reports, how to build a good credit history and keep your accounts healthy, how to maintain a balanced debt-to-credit ratio, how to avoid common mistakes and scams that can hurt your credit. By the end of this video, you'll know how to repair your credit and increase your score. But before we dive in, please hit the like button and subscribe to my channel. It helps me a lot and motivates me to create more content for you. And turn on the notification bell so you don't miss any of my future videos. Thank you for your support. Alright, let's start with checking your credit score and credit reports. Check your credit score and credit reports. The first step in repairing your credit is to know where you stand and what factors affect your score. You can check your credit score for free from various sources, such as your credit cards, banks, apps, or websites. Some of the popular options are Credit Karma, Credit Sesame, Experian Boost, etc. You can also check your credit reports for free from the three major credit bureaus: Experian, Equifax, and TransUnion. According to a Consumer Reports investigation, 34% of Americans found at least one error on their credit report. If you find an error on your report, such as a wrong name, address, account, balance, payment, inquiry, collection, etc., you should dispute it with the credit bureau that issued the report as soon as possible. You can dispute an error online, by phone, or by mail. You'll need to provide some personal information, a description of the error, and any supporting documents or evidence that prove the error. Once the dispute is completed, you'll receive a notification of the outcome and a copy of your updated report if there are any changes. You can also request the Bureau to send a notice of correction to any creditors or lenders who received your report in the past 6 months. If the dispute is successful and the error is removed or corrected, you may see an improvement in your score almost immediately. But if the dispute is unsuccessful and the error remains on your report, you can either contact the source of the information, such as the creditor or the collection agency, and ask them to verify or update the information, or file a complaint with the Consumer Financial Protection Bureau, CFPB, or the Federal Trade Commission, FTC. Build a good credit history and keep your accounts healthy. The third step in repairing your credit is to build a good credit history and keep your accounts healthy. Your credit history is the most important factor in your credit score, accounting for 35% of it. It shows how well you pay your bills on time and how long you've been using credit. To build a good credit history and keep your accounts healthy, you should follow these tips. Pay your bills on time every month. This is the best way to show that you're a responsible borrower and that you can manage your debt. Late or missed payments can hurt your score and stay on your report for up to 7 years. If you have trouble remembering or making payments, you can set up automatic payments, reminders, or alerts to help you stay on track. Keep your balances low. This means that you should avoid using too much of your available credit and pay off your debt as soon as possible. Your credit utilization ratio, which is the percentage of your available credit that you use, affects 30% of your score. A high credit utilization ratio can indicate that you're overextended and may have trouble paying back your debt. A low credit utilization ratio can indicate that you're using credit wisely and have more room for borrowing. As a general rule, you should keep your credit utilization ratio below 30% on each account and across all accounts. Don't close old accounts. This means that you should keep your old credit cards or loans open and active, even if you don't use them anymore or have paid them off. Closing old accounts can lower your score by reducing your available credit, increasing your credit utilization ratio, and shortening your credit history. Old accounts can help your score by adding more available credit, lowering your credit utilization ratio, and lengthening your credit history. The only exception is if an old account has an annual fee or a high interest rate that costs you more money than it benefits you. Don't open new accounts too often. This means that you should avoid applying for new credit cards or loans unless you really need them and can afford them. Opening new accounts can lower your score by creating hard inquiries on your report, which affect 10% of your score. Hard inquiries are requests for new credit that show up on your report when you apply for a credit product. They can indicate that you're seeking more debt and may have trouble paying it back. They can also lower your average age of accounts, which affects 15% of your score. Your average age of accounts is the average length of time that you've had all of your accounts open. A higher average age of accounts can indicate that you have more experience and stability with credit. A lower average age of accounts can indicate that you have less experience and stability with credit. Use different types of credit. This means that you should have a mix of different types of credit products, such as credit cards, loans, mortgages, etc., on your report. Your credit mix affects 10% of copy received message. It may take some time and effort, but it's worth it in the long run. Please give this video a thumbs up. We'll see you in the next one. Thanks for watching. Goodbye.